I think we have to be specific to which segments we're looking at. Again, it fits into this overall concept of very aggressive rotational trades across the economy and across markets. We have seen a significant sell down in a lot of the tech, crypto, green energy spaces. If you look at a thematic basket that we run here at JP Morgan for unprofitable tech, which generally tend to be extremely high growth, that basket has underperformed the S&P by over 40% over the course of the past 3 months. That's the largest thematic basket underperformance that we've seen across all the baskets we run globally over the course of the last 10 years. So you have seen these very short, sharp adjustments across asset classes. We actually do think it's time to start looking at some segments of tech to bottom fish. Not all, because again, we are starting to see demand differentials forming across different elements of the tech supply chain. But where we are seeing cash flow generative tech companies, we are seeing opportunities to bottom fish here.
I guess the problem that we get into, when we become either extreme or overbought is because, humans can act like lemmings, if you like, if you'll excuse that terminology. But, it becomes a situation of fear of missing out. So everyone jumps on the bandwagon and then suddenly the bubble pops. But things can remain overbought and things can remain even overvalued for quite some time, can't they, James? So what would be the warning signs that people can watch out for to be able to tell them that maybe that's not such a good idea?
So one of the things that we see in asset markets is things generally tend not to correct until there is a catalyst. And at the moment, what we're seeing is valuations are stretched. However, earnings are coming through in a very big way. If we look at the large economies in the US and Europe, you're seeing these companies on average beat already increased expectations by over 20%. You're looking at 50% overall EPS growth in the US, 42% out of Europe. And so they're beating already increased expectations, which doesn't serve as a catalyst for a correction necessarily. The critical element that we're watching here is really inflation. And the number that I would focus people on is the number 3. And ultimately, 3% inflation is a critical turning point that triggers differential performance across asset classes. For inflation between 0 to 3%, equities can outperform in a very sustainable way. Above 3%, however, you start to see equity market underperformance and real asset outperformance. And so think things like oil and energy, think things like base metals, think things like agriculture. And so we're really watching that 3% level very closely.